So let's talk about one of the most argued over companies out there, MicroStrategy. To a lot of people, it looks like a ship sailing headfirst into a storm, with a madman at the helm. But is that what's really going on? We're going to break down their controversial strategy to figure out if this ship is truly unsinkable, or if it's about to go down.
Okay, let's just dive right in. All the fear, all the panic around MicroStrategy, it really boils down to this one question. You hear critics and short sellers all the time warning that the company is on the brink of collapse, buried under this mountain of debt and tied to the crazy price of Bitcoin. They see a ticking time bomb.
And this is the number that gets everyone spooked. $8.2 billion. Now look, on its own, that figure is absolutely terrifying for any company. It's the perfect headline for a really scary story. But as we're about to see, it's the details behind that number that really matter. All right, so let's start peeling back the layers here. What if I told you that massive, scary number isn't actually what it seems? See, behind all the fear is a pretty brilliant financial strategy. Some call it a masterclass, but you can just think of it in simpler terms. It's basically a free money trick. This right here tells you everything you need to know. A normal company with this much debt, they'd be paying something like $500 million a year just in interest. They'd be constantly bleeding cash just to stay afloat. But now, look at MicroStrategy. Their debt is special. It comes with an interest rate of pretty much zero. So what's the result? They've borrowed billions, but without that crushing annual cost. There's no cash bleed. So you're probably asking, how in the world do they pull this off? Well, it all comes down to something called a convertible note. Just think of it like a special kind of loan. It gives the person lending the money a choice. They can either get paid back in cash, or they can swap that debt for company stock later on. And because those lenders might get a piece of the action, they're willing to loan out money at incredibly low, sometimes literally 0% interest. It's the engine driving that whole free money strategy. Okay, so the debt isn't draining their cash every single day. That's huge. But what happens if the price of Bitcoin crashes? I mean, surely that's when it all falls apart, right? Well, let's actually look at that doomsday scenario and see why it might not be the threat everyone thinks it is. And here is the second crucial piece of the puzzle. The debt is unsecured. This is a really important detail. Think of it like a credit card versus a car loan. If you miss a payment on your car loan, the bank can come and take your car. But with a credit card, there's no specific thing they can just come and grab. It's the exact same idea here. The lenders can't just show up and seize the company's Bitcoin. So this brings us to that death spiral scenario that you always hear critics talking about. The idea goes like this. First, the price of Bitcoin drops. Then, the lenders panic and hit them with a margin call, which forces MicroStrategy to sell its Bitcoin into a falling market. That selling, of course, pushes the price down even more, which triggers more selling, and on it goes until the whole company just collapses. But here's the reality check. That margin call, the one that's supposed to kick the whole thing off, it literally can't happen because the debt is unsecured. Their Bitcoin was never put on the table as collateral in the first place. There is no automatic trigger that forces them to sell just because the price goes down. That whole death spiral idea, it's a myth. So, if the company isn't bleeding cash and they can't be forced into selling their Bitcoin, what does that actually mean for their stock? Well, all this fear sloshing around in the market has created a very strange and rare situation, and maybe, just maybe, a real opportunity for people who look past the scary headline. You see, because so many people are laser focused on all the things that could go wrong, this weird gap has opened up. The company's stock is sometimes trading for less than the actual cash value of the Bitcoin it holds. The market has basically priced in so much fear that it's overlooking the billions of dollars in assets just sitting right there on their balance sheet. And just how big is that gap? Well, at times, buying their stock has been like buying Bitcoin for 90 cents on the dollar. All that FUD, the fear, uncertainty, and doubt, it's become so intense that it's created a pretty significant discount for anyone who's willing to just look a little bit closer. So let's just break down what you're getting in this package. First, you're getting Bitcoin, but at a discount. Second, you get their entire legacy software business, which, by the way, is profitable, pretty much for free. And third, you get the benefit of that massive interest-free loan working in your favor. Okay, but what about the absolute worst-case scenario? What if the markets just totally freeze up when the debt is finally due years from now and they can't get new loans? Is there one last line of defense? Well, let's take a look at the company's final safety net. This right here, this is their ultimate trump card. The company's entire massive stash of Bitcoin is what's called unencumbered. Now, that's just a fancy financial term that means they own it free and clear. There are no other loans against it, no claims on it. It is 100% theirs.
So what that really means is, in a true last-ditch emergency, the company is sitting on a fortress of assets. They have billions and billions of dollars in clean collateral that they could absolutely use to get a loan if they needed to. It's this huge reservoir of cash just waiting, a final safety net that honestly, most companies could only dream of having.
So let's bring this all the way back to our original question. Are we looking at a reckless captain steering his ship straight toward an iceberg, or is something else entirely going on here?
You know, the popular story, the one that's easy to tell, paints a picture of a reckless captain just gambling everything away. But that story always misses one key detail. He's not just the ship's captain, he's also the ship's engineer. The whole structure, the zero interest debt, the unsecured terms, that mountain of clean assets, it was all deliberately engineered for one thing: to be resilient.
So, is MicroStrategy a speculation? Oh, absolutely. It's volatile, it's unconventional, but the argument here is that it's not some fragile house of cards waiting to get blown over. The captain isn't going down with the ship because he built it specifically to float in the very conditions where other ships would drown. So the real question isn't whether it can survive the storm, but whether it was actually built to master it.